Today, we examine the recent financial market earthquakes and ask, are these indicators of more trouble ahead? Welcome to the Property Imperative Weekly to the 24th of March, 2018. Hello again. I'm Martin North, Principal Analyst at Digital Finance Analytics. In this week's review of property and finance news, we start with the recent market movements and consider the impact locally. The Dow 30 has come back, slumping more than 1,100 points between Thursday and Friday, and ending the week in correction territory, meaning down more than 10% from its recent high. The volatility index, the VIX, which shows the perceived risks in the financial markets, also rose, up another 6.5%. Just yesterday, 224.8, not yet at the giddy heights it hit in February, but way higher than we've seen for a long time. So, perceived risks are higher. And the Aussie dollar slipped against the US dollar to below 77 cents, from above 80 cents, and it is likely to drift lower ahead, which may help our export trade, but it will likely lead to higher costs for imports, which in turn will put pressure on inflation and the RBA to lift the cash rate. The local stock market was also down significantly. Here is a plot of the S&P ASX 100 for the past year or so. We are back to levels last seen in October 2017 and expect more uncertainty ahead. So let's look at the factors driving these market gyrations. First, of course, President Trump signed an executive memorandum imposing tariffs of up to $50 billion in Chinese imports. And in response, the Dow slumped more than 700 points on Thursday. There was a swift response from Beijing, who released a dossier of potential retaliation targets on 128 US products. And targets include wine, fresh fruit, dried fruit and nuts, steel pipes, modified ethanol and ginseng, all of which could see a 15% duty, while a 25% tariff could be imposed on US pork and recycled aluminium goods. We also heard Australia's exemption from tariffs may be only temporary. Some other factors also weighed on the market. Crude oil prices rose more than 5.5% this week, following a draw on US crude supplies and rising geopolitical tensions in the Middle East. Crude settled 2.5% higher on Friday after the Saudi energy minister said OPEC and non-OPEC members could extend production cuts into 2019 to reduce global oil inventories. Here is a plot of Brent oil futures which tells the story. Bitcoin's promising rally faded again. Earlier, Bitcoin rallied from a low of $7,240 to a high of $9,175, thanks to easing fears from a G20 meeting that they thought might encourage a crackdown on cryptocurrencies. In fact, finance ministers and central bankers from the world's 20th largest economies only called on regulators to continue their monitoring of crypto assets and stopped short of any other specific action to regulate cryptocurrencies. So, Bitcoin rose 2% over the past 7 days, Ripple XRP fell 8.93%, and Ethereum fell 14.2%. I want to make the point that cryptocurrencies remain highly speculative. I'm still working on my detailed post as the ground keeps shifting. Gold prices enjoyed one of their best weeks in more than a month, buoyed by a flight to safety as investors opted for a safe haven thanks to the events we've been discussing. However, the futures data shows many traders continue to slash their bullish bets on gold. So it may well be that it will not rise much higher. Then there was the Federal Reserve statement, which, despite hiking rates by 0.25%, failed to add a fourth rate hike in its monetary policy projections and also scaled back its labour market expectations. Some argued that the Fed's decision to raise its growth rate but keep its outlook on inflation relatively unchanged was dovish. Growth is expected to run at 3%, but core inflation is forecast in 2019 and 20 at 2.1%. They did, however, signal a faster pace of monetary policy tightening, upping outlooks on rates for both 2019 and 2020. You can watch our separate video blog on this. The dots chart also showed more to come, with up to 8 lifts over the next 2 years, which would take the Fed rate to well above 3%. The supporting data shows that the economy is running hot and inflation is still expected to rise further. Now, this will have global impact. The era of low interest rates is ending and the QE experiment is also over, but the debt legacy will last a generation. All of this will have a significant impact on rates in the financial markets, putting more pressure on borrowing companies in the US and the costs of government debt. In fact, US mortgage interest rates rose again, a precursor to higher rates down the track. Moody's said this week that the US's still relatively low personal savings rate questions how easily consumers will absorb recent and any forthcoming price hikes. Moreover, the recent slide by Moody's Industrial Metals Price Index amid dollar exchange rate weakness hints of a levelling off of global business activity. The flow and effect of rate rises is already hitting the local banks in Australia. To underscore that, here is a plot of the Aussie dollar bill OIS swap rate, a critical benchmark for bank funding. In fact, looking over the past month, the difference or spread has grown by around 20 basis points, and this of course is independent from any expectation of an RBA rate change. The BBSW is the reference point used to set interest rates on most business loans, and also flows through to personal lending rates and mortgages. As a result, there is increasing margin pressure on the banks. In the round, you can assume that a 10 basis point rise in the spread will translate to a 1 basis point loss of margin unless banks reduce yield on deposit accounts or lift mortgage rates. Individual banks are placed differently, with ANZ probably the most insulated thanks to the recent capital initiatives, and Suncorp the most exposed. And in fact, Suncorp already announced that variable owner occupied principal and interest rates will rise by 5 basis points. Variable investor principal and interest rates will increase by 8 basis points, and variable interest only interest rates will go up by 12 basis points. And in addition, their variable small business rates will increase by 15 basis points, and their business line of credit rates will increase by 25 basis points. Expect more ahead from other lenders. The key takeaway is that funding costs in Australia are going up at the time when the RBA is stuck in neutral. It highlights how what happens with rates and in money markets overseas, and particularly in the US, can have repercussions here. Repercussions that many are possibly unprepared for. Locally, the latest Australian Bureau of Statistics showed that home prices to December 2017 fell in Sydney over the past quarter, along with Darwin. Other centres saw a rise, but the rotation is in hand. Overall, the price index for residential properties for the weighted average of the 8 capital cities rose 1% in the December quarter. The index rose 5% through the year to December 2017. The capital city residential property price indices rose in Melbourne, up 2.6%, Perth 1.1%, Brisbane 0.9%, Hobart 3.8%, Canberra 1.7%, and Adelaide 0.6%, and fell in Sydney down 0.1%, and down in Darwin down 1.5%. You can watch our separate video on this, where we also covered in more detail the January 2018 mortgage default data from Standard & Poor's, which increased to 1.3% from 1.07% in December. No area was exempt from the increase, with loans in arrears by more than 30 days increasing in January in every state and territory. Western Australia remains the home of the nation's highest arrears, where loans in arrears more than 30 days rose to 2.44% in January from 2.08% in December, and that reaches a new high. Conversely, New South Wales continued to have the lowest arrears amongst the most populous states at 0.98% in January. Moody's is now expecting a 10% correction in some home prices this year. According to the latest figures by the Australian Bureau of Statistics, the seasonally adjusted unemployment rate increased to 5.6%, and the labour force participation rate increased by less than 0.1% to 65.7%. The number of persons employed increased by 18,000 in February. So, no hints of any wage rises soon, as it's generally held that a 5% unemployment rate would lead to higher wages. Even then, though, I'm less convinced. The latest final auction clearance results from CoreLogic, published last Thursday, showed that the final auction clearance rate across the combined capital cities rose to 66%, across a total of 3,136 auctions last week, making it the second busiest week for auctions this year, compared with 63.3% the previous week. But it's still well down from 74.1% a year ago. Although Melbourne recorded its busiest week for auctions so far this year, with a total of 1,653 homes taken to auction, the final auction clearance rate across the city fell to 68.7%, down from 70.8% the previous week. In Sydney, the final auction clearance rate increased to 64.8% last week, from 62.2% the week prior. And across the smaller auction markets, clearance rates improved in Brisbane, Perth and Tasmania, whilst Adelaide and Canberra both returned lower success rates over the week. CoreLogic say that Geelong was the best performing non-capital city region last week, with 86.1% of the 56 auctions successfully cleared. However, the Gold Coast region was host to the highest number of auctions at 60. This week, they are expecting a high 3,689 planned auctions today, so we will see where the numbers end up. I'm still digging into the clearance rate question and should be able to post on this soon, but remember that number, 3,689, because the baseline seems to shift when the results arrive. As interest rates rise in a flat income environment, we expect the problems in the property and mortgage sector to show, which is why our forward default projections are higher ahead. And we're going to update that data again at the end of the month. Household financial confidence also drifted lower this month, as we recently reported. It fell to 94.6 in February, down from 95.1 the previous month. This is in stark contrast to the improved levels of business confidence, as some have reported. Our latest video blog covered the results in more detail. Finally, the Royal Commission, of course, took a lot of airtime this week, and I did a separate piece on the outcomes yesterday, so I won't repeat myself here. But suffice it to say, we think the volume of unsustainable mortgage loans out there is clearly higher than the lenders want to admit. Mortgage broking will also get a shakeout, as we discussed on the ABC this week. And that's before they touch on the wealth management sector. We think there are a broader range of challenges for bankers and their customers, as I discussed at the Customer-Owned Banking Association conference this week. There is a separate video available in which you can hear what the future of banking will look like and the importance of customer centricity. But in short, expect more disruption ahead, but also significant opportunity if you know where to look. I also make the point that ever more regulation is a poor substitute for the right cultural values. At the end of the day, a CEO's overriding responsibility is to define the right cultural values for the organisation, and the major banks have been found wanting. A quest for profit at any cost will ultimately destroy a business if it, in the process, harms its customers and encourages fraud and deceit. You simply cannot assume banks will do the right thing unless the underlying corporate values are set right. Remember Greenspan's testimony after the GFC when he said, "I made a mistake in presuming that the self-interests of organisations, specifically banks and others, were such that they were best capable of protecting their own shareholders and their equity in the firms." If you found this useful, please do like the post and add a comment or a question. I read them all. If you've already subscribed, thank you so much. I'm really grateful for your support. And if you have yet to subscribe, please do so to receive future alerts. I'm Martin North, Principal at Digital Finance Analytics. Many thanks for taking the time to watch.